All right. Good morning or afternoon, everybody. My name is David Sedia. I'll be taking you through a little bit of tax planning, a couple of strategies as federal employees to look to use, and we'll also kind of walk through a scenario of what this looks like and how you could implement that for yourself. We have a smaller group today, so I will take questions throughout the presentation. And then at the end, we'll have a Q&A for any kind of leftover questions at that point. A little bit about myself. I'm a chartered mutual fund counselor, as well as a federal employee benefits specialist with over 10 years of experience dealing with specifically federal employees. Essentially, the purpose of today is to give you a clear understanding of how your federal benefits interrelate with financial and retirement planning strategies. In today's case, that's going to be heavily related around taxes and taxes in retirement. So let's kind of jump into things. First things first, U.S. tax system is progressive. That means that you don't pay a fixed rate, you pay a rate based upon different tiers. And then in addition to that, there are long-term capital gains and qualified dividends, which are taxed a little bit differently. That would be for non-retirement accounts, home sales, or things like CDs or money market accounts. Itemized deductions. Obviously, if you are not taking the standard, you might be itemizing because that amount exceeds the standard deduction. A couple of things that count towards that: mortgage interest, property taxes, charitable donations, and medical expenses. If not, we got a little bit of an increase here to the standard deduction for 2024. For single filers, that jumped up about $850 or $750. And then the joint also got about a $1,500 increase as well. Same thing happened with tax brackets, which we'll talk about. That got a bigger increase. So kind of looking at tax return, what determines your ordinary income is really going to be your wages and salary, any distributions from retirement accounts, qualified dividends, and short-term capital gains. Those are going to be the figures that count towards your ordinary income rate. So looking at ordinary income here, we want to look at the current tax rates versus the previous. So first and foremost, we have the new tax rates for 2024 up here on the screen. It got about a 5% increase to the different thresholds for the tax brackets. And the one major factor here that we want to consider is that tax rates are set to go back to the way that they used to be back in or prior to 2018, so 2017 and earlier. And one of the big factors there is they are higher percentages, right? When we look at the not the lowest bracket, but the second through the fourth here, especially, you'll notice a pretty big difference in all except for the 32% from where they were. So you're looking at starting in 2026 about a 3% increase to your federal taxes. Now, the other big factor here for any of those of you who are joint filers, this is something that will have an impact here, is the top of the bracket of the fourth tax bracket ends at a much lower dollar amount, right? $233K as opposed to $383K. So for those of you in a household where probably, two of you are working who are joint filing, it is a lot easier to enter into the 33% bracket in the future in 2026 when these tax rates revert back. So that is going to be something of concern. And if that applies to you, you want to make sure that you've done adequate planning ahead of time to try and mitigate what that will impact you with. Long-term capital gains. These are, as I mentioned earlier, a fixed rate. Across the top, we have the different ones. We have 0%, 15, and 20. Most of us, that's going to be 15%. There might be maybe a small amount of us on the line who might be in the 0%. Probably not really many, if any, in the 20%. So for the most part, long-term gains are a flat 15% rate on the federal side. However, they are also added to your state taxes as well. As I mentioned in the very beginning, these are going to be things like a sale of a rental property, or if your current home grew a lot in value, then that as well. Non-retirement accounts, CDs, money market accounts, those will also apply. Utilizing these, there are capital losses in ordinary income, and a loss can help you offset your income. And if you didn't have, or if you had a lot of losses in one year, you could also use it and carry forward and use up to $3,000 a year to help offset some of your income. This is a concept that doesn't have a significant benefit unless you have a lot of losses. And the way that the market has been over the past 10 years, odds are most of us are looking more so at having gains in our account as opposed to losses. However, you might have some losses from 2022, which wasn't exactly a great market year. So just a little tidbit is you can save a little bit by claiming your losses against your ordinary income. Net investment income tax is an area that not a lot of people are very familiar with. Net investment income tax is a additional tax on non-retirement income for those of you who are above a certain income threshold. So the income threshold depends on your tax filing status. If you're filing jointly, it's 250K. Filing separately, it cuts it in half. If you're single, it's 200K, and head of household, also 200K. And what this is this is a additional 3.8% tax on investment income. That would be things like a non-retirement account, a rental property, CDs, money market, as I mentioned earlier, a lot of the things that the capital gains rate applies to. And this would also apply to dividends that would be accrued throughout. So it's just an extra 3.8% tax. So something that we look at in tax planning is we look at trying to find ways to keep our income below these thresholds if you have a number of dollars outside of retirement assets. So this is a little way to save a little bit of money in taxes. Let's talk about some additional deductions and credits, and then we'll kind of get into a little bit more of the fun stuff, which is kind of walking through some scenarios in how this will play out. So first things first, we have something called a donor advised fund. There may be some of you here who give money to charity. A donor advised fund is essentially like a investment account where you can have its sole purpose as donating to charities over time. And what you're able to do is as you put money into this donor advised fund, you get a immediate tax deduction there. And the money that you put in there grows tax-free as long as it's being used towards charities. So it would be a way to get a bigger tax deduction, let's say in a year where you might have higher income than usual. Or this could just be a one-time deduction where you want to itemize your taxes in a given year, as opposed to taking the standard deduction every year, where it's harder to, essentially, it's harder to itemize taxes and have enough deductions where it's worth it to itemize versus take the standard deduction in some cases. And this would be a way to do so. So for anybody already giving to charity, this is a great way to go about doing so and getting a bigger deduction earlier on while you're still working. Child tax credit. I think a lot of this is pretty straightforward at this point. There was the American Rescue Plan that went into effect back in 2021, which increased the credit per child for children under the age of 6. They also authorized advance payments to eligible families for half of that deduction throughout the course of the year. So it's just something to keep in mind. Most people, I'm sure, are already kind of claiming this on their taxes. Another big one here is the home sale gain exclusion. This is something I talk with clients quite a bit about as they relocate after retirement or just throughout life, are moving to homes, maybe even in the same area. And essentially, the main factor here is as long as you've lived in the same property for 2 of the last 5 years before the sale of the home as your primary residence, then you are allowed to take this exclusion, which allows you as a single filer, $250,000 of growth in value of your home is completely tax-free. For anybody who is married filing jointly, that number is doubled to 500,000. So one of the items that you may want to consider in your home is if you are getting close to that 250 or 500K number, some people might consider moving at some point, depending on obviously a lot of factors, but you may consider moving so that you capitalize on this home sale exclusion, buy a new home, and then that whole clock resets, and then you would get another 250 or 500K of value in the new home before you would pay any taxes. Obviously, a number of other factors come into mind, like the interest rates right now for mortgages are rather high. So that's not always going to be the best strategy. Talking to somebody might be a good idea about that piece. But as far as planning goes, when you get closer to that home sale exclusion, that's typically a good time to consider a potential change in property. Another option for anybody considering moving, if you have a lot of gains in your home, is you can do something called a 1031 exchange. And 1031 exchange allows you to sell one property and buy another property as long as they happen in a short window of time. So number one, you must identify the property you're moving to within 45 days from the sale of your current home, and then you must close within 180 days of that. And what this allows you to do is transfer over all of your profits from your current home to the new home, and would allow you to avoid paying anything in taxes during that transition. Now, of the future home, there of course may be some taxes involved there as well. One of the reasons that this might be a beneficial thing, and this deals with a property or also non-retirement or trust assets that may be invested, is you get something called a step up in cost basis. So let's pretend that you have a property that is worth $500,000 right now. And let's pretend on the left-hand side here that you purchased that, as we'll see here in the blue, you purchased that for 200K, right? And you sell your home. Well, right now, if you were to just sell that home, you would pay taxes on some of that profit, right? I mentioned the home sale exclusion, 250K would be tax-free, but you would pay taxes on the extra 50K of profit. But if you pass on a property through death, or for a lot of you, this could also be something that applies for maybe your parents, right? Or a relative. So if a property is passed on through death, it gets what's called a step up in basis. And a step up in basis would mean that your purchase price on that property that you may inherit or you may pass on becomes the value of that property on your date of death or their date of death. So if somebody purchased a home for 200K, it's worth 500K now, and they pass it on through death, your purchase price will become the full 500K. Meaning if you were to turn around and sell that property the next day, you wouldn't pay a penny in taxes. Now, if that home grows in value, you would pay taxes on the growth. But if you then in that property live for 2 years and then sell it, any of that additional growth above the 500K would probably be tax-free because it probably wouldn't have grown more than that home sale exclusion. So as you can see, there's a lot of ways to juggle around a property that either you have or you inherit or that you want to pass on. But one of the big things here is, for example, having yourself or your parents gift a property. Let's say your parents get, I actually just had this conversation with a client yesterday. Let's say that your parents want to gift you a property or sell it to you for a cheaper deal. It would be better financially for them to just simply pass that on through death as opposed to purchasing or selling it, where you have realized taxes. And then if they sell it to you for a cheaper amount, then you're going to have a lot of growth in value of that property, which will probably lead to you paying quite a bit in taxes. So there is a lot of strategy here. Now, I show you this because there is also something in Biden's tax proposal, which has discussed potentially removing the step up in basis. It would be a personal opinion that this is a very generous thing that is currently in the tax code. I think it would be very tough for them to remove, but it is something that currently and for a large number of years has been around. It's just a matter of knowing it in order to take advantage of it. So talking about Biden's tax proposals here, obviously one of the big things here is our national deficit is significant and has only been climbing really significantly since 2020, but even prior to that, it's been continuing to grow. As well as the projections for the next 10 years is that that will continue to expand as time progresses. So some of the things that are being looked at as ways to mitigate that are things like increasing the TOPS tax rate back to 39.6, which is currently 37. I think we all can agree that makes perfect sense. Taxing capital gains and dividends at ordinary income for those earning more than 1 million. Expand the net investment income tax that we talked about earlier to 5% for income above 400K. Right now, it's just a flat 3.8%. Eliminating the step up in basis, which is what we were just discussing. Raise the corporate tax rate to 28% and billionaire minimum tax rate of 25% and taxing unrealized gains for anybody with a net worth above 100 million. Now, for most of us, none of these really affect us except for the eliminating the step up in basis. So that's just something that we want to be aware of. And it is, of course, a proposal. Nothing has been passed on this front, but it is something we're keeping an eye on. But as of right now, you want to factor in that the step up in basis is one of the least likely of these to essentially pass. And what I would recommend is as you plan that you plan assuming that this will kind of stick around for a bit of time. A couple other considerations here when it comes to taxes is where you live now, where you're going to live in retirement or later in retirement. There are some states with no income taxes at all. There are also certain states which do not tax your pension at all. Now, that is on the state level, not the federal level. You'll still have federal tax. There are also some states like Pennsylvania, for example, where they don't tax your pension, they don't tax your Social Security, and they don't tax withdrawals from a retirement account like your TSP. So essentially, they are more or less like a tax-free state. Also, interestingly enough, a state like New York, they do not tax federal pensions, nor do they tax withdrawals from your TSP, which is actually a pretty interesting factor. So New York is actually a more tax-friendly state than a lot of people may think. So you want to do your homework on where you live just to understand the taxes and implications there, because a number of them may surprise you. And there are a number of states, not even on this list, which might be very advantageous to live in, like Delaware, for example, where they have very low property tax and they don't have sales tax. So all these states kind of get you one way or another, whether it's property tax, sales tax, state tax. They all typically kind of even out a little bit in the end. but some of them do come out a little bit ahead. So you just want to do your research on that. There was a act passed back in 2022 called the Secure Act 2.0. It did a couple of things that we're going to kind of walk through with some scenarios. Number one, it raised the age for the required minimum distribution to 73. Also, for anybody who's not going to be 73 by 2033, that required distribution age is actually going to be 75. That is most likely going to be the last time that they really raise that distribution age for quite some time. But this was part of a series of updates which raised this distribution age from 70 and a half to 72 with the Secure Act 1.0. Now it's 73 and potentially 75, depending on how old somebody is right now. It also removed the requirement for employer-sponsored Roth accounts to have a required distribution. So previously, if you had to take a required distribution from your TSP account, you were also forced to pull money out of the Roth TSP as well, assuming that you had any money in the Roth TSP. This act did remove that feature. There is also a way where you can use any leftover money from a college funding plan or 529 account, as long as it's been open for more than 15 years, and you can use that to contribute to a Roth IRA. So that is something that is set to go into effect this year in 2024. And then all of those have been good things. Now we have the bad. How you inherit money has changed. So if you are a non-spouse beneficiary, meaning if you inherit money from a partner who is not a spouse, if you inherit money from a sibling or a parent, you are required now to pull that money out of a retirement account within 10 years. Now, that doesn't mean you have to spend it, but it means you have to take the money out, pay taxes on it, and then what you do with it is essentially up to you. The main thing here that's an issue compared to the past. In the past, you used to be able to take a very small withdrawal based on your age over the course of your life. Basically like a baby required distribution, more or less. It was a smaller percentage. But now you have 10 years to empty the account. Now you can customize it. You don't have to take a portion out every year, but by the end of 10 years, the 10th year anniversary of the death of the decedent, you will have to have that account emptied. So this has some pretty big tax implications. So we're going to kind of walk through what this kind of looks like. So let's just kind of start and talk about the inheritance of a traditional retirement account. So let's pretend that you inherit $500,000 and you invest it in a way where it's growing at 5%. What will happen is you'll be pulling money out each year, and over the 10 years, you'll probably end up taking something like $60,000 out of the account a year if it was to be leveled. And the reason for that is that 500K is going to be growing, right? So it's not just a even 50K a year. So you take out 60K, you pay taxes on it, and by the end of 10 years after taxes, you would walk away with 460K from the account. Now, something you want to consider if you are in a position where you might inherit money, what does that do to your taxes, right? If you inherit this money on top of your own income or on top of you and your spouse's income, what are the tax implications that creates for you? Does that potentially push you in a higher tax bracket? And a conversation we have when we look at family planning with clients and their parents is what your parents do or what you do for yourselves have implications for your kids, right? Or your parents for yourselves, and how that money gets passed on. So now let's look at what it would happen if that was from a Roth plan. So if you inherit money in a Roth account, or if you pass on money in a Roth account, Your money will grow completely tax-free during that 10-year stretch for your beneficiaries. And you have the choice, or your beneficiaries have the choice, that they could, of course, take money out during that time. But it would be very wise to train beneficiaries to know that the most beneficial thing would be leave the money in the account for those 10 years, let that money grow, and then at the very end of 10 years, take that money out, right? Because all of that, in this case, 500K is in Roth. It's not going to be taxed whatsoever, or the growth. So in this case, you don't have to take anything out during these years. And then at the very end, because of that compounding growth, 5% a year on 500K, 10 years later is 815K. And they get to pull that out completely tax-free. So there's a huge advantage to the way that that money is passed on. And I'm going to actually take a quick second here to answer a question that came in that I think probably a couple others might be curious about, which is, I talked about this being the case with a non-spouse. And the question is, are there any requirements for IRA inheritances for spouses? So no, there is not. So in the case that you inherit money from a spouse, number one, if you are younger than your spouse, you can consolidate that money into an IRA in your own name. So that way it will go off of your age for required distributions. If your spouse was younger than you, then you can put that over into an inherited account where you would have the distributions in the future based off of your spouse's age. So you will be able to kind of pick and choose the better method there, but there is no requirement that you need to empty the account in the case that it is from a spouse. All right, so kind of moving on, I mentioned required distributions. So the required distributions begin at 73. Then I mentioned also potentially 75. So again, if you are not going to be 73 by the end of calendar year 2033, then your required distribution age will be 75. The first distribution is not due until April 1st of the following year. So if you turn 73 this year, for example, your first distribution won't be due until April 1st next year. However, if you delay your first distribution to next year, your second distribution would also be due next year as well by December 31st. So you would essentially have two distributions to take that year. The reason I bring this up is there could be a benefit for anybody who is working very late in their career, who is retiring at or after age 73, where you could find some advantages to this. Also to mention, your TSP does not require you to take a required distribution if you are still working past age 73. An IRA account would. Now, hopefully you're all able to retire before then, very happy and comfortably. But in case anybody is still working, or if you just love doing what you do, then just something good to know is you want to retain money at TSP if you're going to be working later than 73. The required distribution is taxed as ordinary income. It is added to your salary or your pension and your Social Security for tax purposes, which can potentially lead you into a higher tax bracket. As we discussed earlier, required distributions are not required on Roth retirement plans. Also, if you miss a required minimum distribution, there is a 25% penalty. On a $500,000 account, that distribution will be something like $20,000. And as you get older, that number will grow. So if you fail to complete one, that could be, in that scenario, a $5,000 penalty for every distribution that was missed. And we have definitely seen people who have missed several of those and paid pretty hefty penalties. Final part is it is calculated using the IRS divisor table, which essentially looks at your age and gives you a life expectancy, and you will take a percentage of your account out each year based off of that life expectancy. What are some things you can do to avoid this if it is pushing you into a higher tax bracket? I mentioned a different style of giving to charity a little bit earlier called a donor advised fund, or a DAF. There's something else called a qualified charitable distribution, or a QCD. You must be 70 and a half to do this. And what it enables you to do is take money directly from a retirement account and send it over to a qualified charity. And what this will do is this will not count as income for you because it's going to a charity. And number two is this will count as your required distribution or towards it. So if you're kind of on the brink of two tax brackets and giving to charity is something you do or would like to do, this can be a way for you to avoid pushing yourself up into that higher bracket. Or if you're up against the line for net investment income tax, this can be another strategy for that piece. So let's talk about Roth accounts. And I don't have any other questions in the chat. If we have any, I can pause for a second just in case there's any questions before we jump into the next topic. Otherwise, I'll just kind of go ahead and proceed with Roth accounts. All right. Looks like nothing came in. I will, also mention this is being recorded. This recording will be sent out to all of you. Feel free to review it again, share it with any friends or colleagues. And we will also be sending out the slides from today's presentation to everybody. Okay. Well, moving on to Roth accounts here, we want to look at what is the tax treatment here. So when you put money into your traditional TSP, what's happening is you're getting a initial tax deduction. So when we take $20,000 and we put it into your TSP account, you do through your paycheck, right? You're receiving about a $4,200 tax deduction if you're in the 22% bracket. And as that $20,000 grows over time, again, just assuming 5% growth, that would turn into $58,000 in the future. And while you avoided $4,200 in tax initially, in the future, you're going to pay $15,000 tax since you're also being taxed on the growth, which after all those taxes would result with $43,000 in your pocket. If you use the Roth plan, what you're doing is you're not receiving the tax deduction initially. So that full 20,000 is going to be taxed to you right away. And then over time here, over that 20 years, that money grows. And when you pull that out in the future, it will be completely tax-free. So we already talked about the way that that money may be passed on is tax-free, but also just for yourself or your spouse to use, that money is completely tax-free to use over the course of your life. There can be some very good advantages of having Roth money, like if you had a big, large expense in one particular year, and if you were to take all that money out of your traditional, it would push you into a higher tax bracket. If you had a Roth account, what you could do is you can mix and match and take some money from traditional, some money from Roth to avoid that one particular year pushing you up into a higher tax bracket, or also even a higher Medicare premium bracket. So how do you get money into Roth? There are, two major ways that we look at for this. We have Roth conversions and we have Roth contributions. These are very different. And technically there are two styles of contributions, right? The Roth TSP would be one style where the limits are very different. And then there would be a Roth contribution. So a Roth contribution is taking money from a checking account or savings account and moving it into a Roth IRA. This would be done on the outside of TSP. And you can do, and actually, this number needs to be updated here. It is $7,000 now for 2024. So you can do $7,000. And for those of you above 50, you can do an additional $1,000 catch up. So you can put $8,000 if you're 50 plus in a Roth IRA somewhere on the outside. In addition to that, with your TSP, you are able to put $23,000 into your TSP, and that could all go to a Roth TSP hypothetically. In addition, you also have a $7,500 catch up at TSP. So for anybody 50 plus, that means you could be contributing $30,500. And it depends on your situation if Roth is going to be best for you. But as far as just what you're potentially capable of, you could put $30,500 to the Roth TSP and $8,000 to a Roth IRA in the same calendar year. So you could really strategize on your taxes here to get a lot of money into Roth. Some other factors, if you use the Roth TSP, you will still get your match. So a lot of people have asked me, if I put my money to Roth TSP, will I still get the match, or do I need to make sure I put 5% to my traditional? And what TSP cares about is, are you putting 5% or more of your pay into TSP in general? And as long as the answer to that is yes, you will still get your match. However, your match will always go to traditional. Now, kind of moving on to a different concept here is a Roth conversion. A Roth conversion is when you take money that has never been taxed, so traditional money, so IRA, a prior 401k, or TSP money, and you move that money into a Roth account. And you actually are not limited on how much you can convert. Now, there are wise amounts and non-wise amounts depending on your situation, because whatever you move or convert to Roth is taxable to you that year. So you have to look at tax brackets, and somebody 63 or older will also want to consider Medicare premium brackets if you plan to take it, because there will be some tax implications there, or premium bracket implications for what you may pay for Medicare. But the main thing here is a conversion, you can do an unlimited amount. Now, also just to kind of get ahead of some of the questions here, TSP in any employer plan, so this is not just TSP, employer plans do not allow you to do a Roth conversion within the account. Money would have to be moved to an IRA somewhere on the outside, and a Roth IRA opened at that same location in order to do a conversion. So once you contribute money into TSP, if it's traditional, it stays traditional. If it's Roth, it stays Roth. But you can't move money between the two once it's already saved in the account. So that's why for anybody here who's, younger than 59 and a half, how you contribute money to your TSP or IRA on the outside obviously has a lot of implications, because that is what you're in control of. For anybody 59 and a half, that is the first time, or 55 plus and retired, those are the first times that you're able to move money out of your TSP account, where you're able to implement something like a Roth conversion for yourself. So we're going to get into some more details there. And we're going to start out by looking at required minimum distributions impact on your tax bracket. And then we're going to go through an example of how a Roth conversion can help you mitigate what you're going to pay in taxes over your lifetime. So we're going to look at essentially a made-up couple here. This is going to be Joe and Jan. And looking at this, we're going to look at the retirement income before the distribution. So in this case, both spouses plan to take their Social Security early. They're going to take it at 62, which is when you're first eligible. We're going to pretend that they made a identical income. So they're going to have identical Social Security amounts of $27K each. And one of them was a federal employee and is going to receive a pension of $37,900. Obviously, we built this for simple math. The adjusted gross income, the combination of all of that income, will give them a total income of 91,900. And then we're going to take away the standard deduction, or at least in this case, the standard deduction from last year of 25,900. So they are going to be left with a taxable income of 66,000, which, going off of tax brackets off to the right here, that would keep them in the 12% tax bracket. And what we want to look at here is, okay, that means that they have quite a bit of room before the next tax bracket, right? Because if we look at this, the top of that tax bracket is 83,000 and their taxable income is 66,000, which gives them a cushion of $17,000 before they would then enter into the 22% tax bracket. So now that we have this information, we're going to move on and expand a little bit on it. And what we're going to do is we're going to look at the effect of the required distribution on their tax bracket. So first things first, the effect of this on their tax rate is they're going to have to take some money out of their account, right? So we have $500,000 in traditional, and we like to assume very low growth rates just to be conservative. So we're going to look at just 3% growth. So from 62, when they retire and take their Social Security, until 73 at 3% growth, that 500K now becomes 650K. And based off required distributions, that would result in a $28,000 required minimum distribution. Now, where this has an impact, right, is if we take that 28K and we add that to the 66K that they had, which was, again, their income from the pension and Social Securities, that gives them a total income of 94K, which, going off of tax rates, right, means some of that income now is going to be taxed at 22%. On top of that, that required distribution had them take out enough money that it would impact their taxes. And also, any of that money that they had to take out, which is more than what they may need, is going to have impacts now on if they have any money in non-retirement accounts, right? Because their dividends, interest, and capital gains are now going to roll off of the 22% bracket as opposed to the 12%. And they'll be paying essentially an extra 10% on any dividends and capital gains, short-term capital gains that they have on the outside. So a lot of damaging impacts can be created by this. And this is something that I would highly recommend everybody tries to map out for your future. You could also have an advisor, an accountant, potentially help you kind of forecast that. But the big thing here is, as a federal employee having a pension, this required distribution is normally a greater amount than what you need in income for retirement. And then the negative impacts that it has, in this case, on your tax bracket. But even further than that, it could also be on your Medicare premium bracket. And I apologize, the slides normally don't show all of this at once. I'll have to double check what happened here when we updated some things. But one of the things I want to address is how a Roth conversion can help lower your income. So starting out here, we mentioned earlier, the pension and Social Securities minus the deduction was 66K. And this couple had a $17,000 cushion, right, within their tax bracket. So what could they do earlier on in life to help avoid this bigger tax impact, right, in the future? And what they could do is they could utilize this $17,000 threshold and do a Roth conversion of 17K a year, right? So they take 17K out of traditional, they move it to Roth, and they pay 12% taxes in each of those years on that 17K. And fast forward, 11 years, when they are now finally 73, that traditional account, because of those conversions, even though it was growing, they would be left with 370K in that traditional account. And ironically, with the amount, that would lead them to have a $17,000 required distribution, which would keep them in the 12% bracket. On top of that, they now have received 240K in their Roth account because they converted money over and that money also grew. And there is, as we talked about earlier, right, no required distribution on that money. So that will enable you in your own respective scenarios to figure out, you don't want to just look at where am I going to be income wise when I retire, but where am I going to be income wise when all my income streams have kicked in? Your pension, your social security, and especially your required distribution. What is that going to do to your tax bracket and Medicare premium bracket? And is that in a case where you're kind of teetering between two tax brackets where you need to do something about that now or soon so that you don't have that bigger impact in the future? Because in the prior case, that would be something that happens from 73 for the rest of somebody's life. So if you were to get ahead of that and you do a strategy like this, you can save a significant amount of taxes over your lifetime. We've seen anywhere from tens of thousands to hundreds of thousands. It really is very situational here. But the main thing that we've noticed in meeting with a large number of federal employees is 90+% of you using Roth or Roth conversions is something that is going to be beneficial for you. So that means if you kind of, look around, there's, 20 of you on here today. That means 18 out of the 20, potentially even 19 of you can benefit by doing this. So you want to make sure that you go ahead, take a look into your situation, you do some math and kind of look at what this may look like so that you can protect yourself. One other thing that we'll kind of add into this is Roth conversions do have a benefit to do during down markets. Now, the stock market is pretty much right where it was at the end of 2021, but the bond market is not. That means most people's accounts are still down a little bit, and then we also have an election year here. So kind of walking through an example, if somebody had $100,000 in an IRA, and the markets go down and now that's worth 75K, right? If they did a Roth conversion, they're only gonna, in that case, pay taxes on 75,000 as opposed to 100, right? Because it went down in value. So now you move it over and you have $75,000 in a Roth IRA. And when the market recovers, that recovery would happen in the Roth IRA. So when that account recovers and goes back to 100K, that growth, right, that 25K of recovery, that managed to avoid taxes. And then from there, the account continues to grow completely tax-free. So as far as timing goes, there is an advantage to do conversions while the market's down. And as I mentioned, markets are indeed still down from their peak where they were at the end of 2021. Especially the bond market still down about 13%. So if a Roth conversion does make sense for you, doing it in the earlier part of this year would make sense. And then typically moving forward from there, most people are doing conversions towards the end of the year once they've finished their prior year taxes and once they've figured out how much money they've needed from their account, if anything, and then doing a conversion around September, October, November, that kind of time frame. The deadline for a conversion is December 31st on that note. So a couple things to mention. Obviously, this is a lot of calculations and things to figure out where you stand, right? What does your future tax situation look like? And what we offer is a financial checkup. There's a QR code as well as a registration link. And some of the main questions that we get that are addressed in this meeting. And I'll also mention this is a complimentary meeting, of course. as part of this presentation package here. So number one, should you be using a Roth TSP or even further than that, a Roth IRA? Does your TSP allocation reflect your investment objectives and your risk tolerance? When should you take Social Security? When can you retire versus when should you retire? Do I need Medicare in retirement, and how does it work with your federal employee health benefit? Are you currently using the right FEGLI options? If you have option B, you want to definitely make sure that you know how that premium increases over time. And then finally, do you have a tax strategy to minimize your future tax burdens, which is what we really spent a lot of time covering today. But having somebody help you run these numbers like I just did in these scenarios so that you can see and understand where you personally are going to fall. So that is what is covered in that checkup. I would also, mention, of course, there are other companies that do this. You want to make sure that you probably shop around and get a couple different opinions. So for anybody out there who may, whether it's now or in the future, look for an advisor, we have 3 pieces of advice here. Number one, start with a background check. There are tons of advisors out there with clean records, and you can do a background check on brokercheck.finra.org, and you can see if any customers have complained against an advisor, if they have a DUI or any kind of criminal history, because there are a lot of good apples out there. You don't need to settle. And you can also see the result of a complaint. Was the advisor correct, or was the complaining client correct? And did they settle? So you can see all that information there. Also check for certifications. Have they done anything outside of just getting their securities licenses? Do they have any kind of continuing education requirements to stay up to date? Because this industry changes very rapidly. And then finally, do they have any experience with federal employees? Do they know what the TSP is, what FEGLI or FEHB are, in a degree where they can advise you rather than you explaining to them what those benefits are and do. So you want to make sure that they have a background in federal employees. That, really concludes today. I know that was probably quite a bit of information. I'm going to switch it over to Q&A now and start answering questions. I see a couple coming in. So if anybody has questions, please type them in the Q&A chat, and I'll stick around and answer all of those. Just as a quick summary, again, this was recorded and will be sent to all of you, as well as the slides. And you are more than welcome to share the recording as well as the slides with any friends, colleagues, or coworkers. So, all right. The first question here is, my partner contributed to a Roth IRA outside of his work retirement account last year, but we realize we're above the limit for contributing to Roth. What can we do to avoid being penalized? So if you over contribute, you are able to go file forms with that banking location. And what they will do is they will undo the contribution as well as any growth associated with that contribution. And what they call it is a excess contribution form. And that will help you undo that Roth contribution. In the future, there is something called a Roth backdoor. It depends on a couple factors if that may work for you, but a Roth backdoor is essentially, in short, a legal loophole for a higher income earner or higher income earning couple who earns above that limit. It is a way for you to still make that contribution. And just for everybody listening, what that entails is putting money into a traditional IRA and then moving it over to a Roth IRA. You can Google it. There's tons of articles that will kind of populate in how that works and also how you report that on your taxes. We do also have a little bit of information on our website about that. And that includes a link to an article that explains how you would file that in TurboTax or H&R Block software, for example, to do that. Next question is, at age 50, is it still wise to put money in Roth TSP if we expect to have a lower income after retirement? So this is a very good question. This is, I think, a lot of what I mentioned earlier. So the first step in tax planning is to figure out where you are eventually going to be in your taxes. So are you initially at retirement? Sure, you probably will drop down in taxes, but what about once you have all of your income? Once you have your pension, your Social Security, and your required distribution? Because the limit, right, is typically pretty low to enter back into what is currently the 22% bracket. I would also bear in mind that in just 2 years, right, starting in 2026, that 22% bracket becomes 25. So if you put money in Roth now at the 22%, compared to even just 2 years from now, you're saving yourself 3% in taxes by using Roth. So I definitely have clients who are using Roth all the way into their 60s, or for anybody working into 70, still using Roth or doing conversions, but it is definitely very situational. Obviously, in the checkup, if you did that, we would, of course, be able to more definitively tell you. But for a lot of people, it is still wise to use the Roth TSP. And what I would say is most likely, without knowing all the numbers here, most likely, at least for the next 2 years, it should still be beneficial because we have the lower tax rates. I think that covers all the questions. If anybody else has any questions, please feel free to send those over. Otherwise, we have the link on the website. I know we have a few more presentations set up with you guys this year. We do also have some recordings on our website of presentations. And every single month, we do a market commentary where we will talk about where we see things going in the economy, in the stock market, the bond market, also covering things like the election, which is going to be a pretty big topic, of course, this year. So those are all posted on our website, or you can sign up for a newsletter and partake in getting some more information. And one more question came in. So how do we get a checkup and how much does it cost? So the checkup, you would just go to either the QR code, you would use the camera on your phone to get to that, or you would type in retfed.com/register, that link below, and it is free. So it is part of our presentation package that a complimentary meeting is available to all of you to take the information today and be able to apply it to your own situation and kind of help answer questions, just because, as you can imagine, we need to keep this information more broad so that it applies to the larger audience of all of you. Whereas the checkup is going to be a lot more specific to your unique case and kind of looking at things we can recommend or point out where you might look to change something, or something that could be improved upon, or something to, kind of look at or consider for the future. So with that, we'll go ahead and conclude for today. So thank you everybody for joining, especially all of you who stuck around for all these questions and answers. And I hope to see you all next time. Please tell your coworkers about us for the next event. I know that we have several others coming up throughout the year. And if anybody has, any questions after the fact, you can also go ahead and submit that to us through our website. And I'll be happy to answer any leftover questions. So thanks, everybody. Hope you all have a great 2024, and hope to see you guys in a future presentation. Thanks, everybody. Take care.